This is the most ridiculous simple trading strategy in the world I know. And remember, stupid simple always work. Now pause for a second because if you are still watching, there's a high chance you're doing something right now that's quietly killing your results. You're thinking more indicators will finally fix it. One more confirmation, one more tweak, one more setting, and every time you do that, you feel smarter, but your account doesn't. Be honest with yourself. How many times have you watched price move exactly where you thought it would just without you in it? Or worse, you entered, felt the little rush of confidence, and then 5 minutes later, you were questioning everything as price snapped back against you. That's not random. That's not bad luck. That's you reacting instead of letting the market show its hand first. So before I explain anything, I want you to look at the chart in front of you. Just look. Don't name anything yet. Don't analyze it. Don't judge it. Just notice how clean it feels. That claim you feel right now. That's what most traders never experience when they trade. This strategy uses moving averages, nothing else. No oscillator, no magic indicators, no hidden filters. And I already know what your brain is saying. Moving averages are lagging. Everyone uses them. They don't work. And that belief is exactly why this works. When you stop using them the way everyone else does, this is not a crossover strategy. We're not waiting for lines to cross after the move is already over. This is not counter trend trading. We're not trying to be heroes catching tops and bottoms. And this is definitely not a setup that traps you in choppy ranges, clicking buttons until your confidence slowly disappears. What you're seeing on the chart looks almost too simple. That's not an accident. On the chart, you'll see 3 moving averages available. The 50 simple moving average, the 100 simple moving average, the 200 simple moving average. They come from a free TradingView indicator called the 3 SMA indicator. Anyone can add it. Nothing special so far. Even though 3 lines are visible, we don't trade all 3. 2 of them matter. One of them decides everything, and if you miss this distinction, this entire strategy falls apart. This works on crypto, stocks, commodities, indices, any market. 1-minute chart, 5-minute chart, all the way up to daily. Not because the markets are the same, but because human behavior around price is the same. Fear, greed, hesitation, impatience, those never change. Right now, you're looking at the gold 1-hour chart. Slow down here. This is where traders usually rush and ruin a good setup. Don't jump ahead. Don't guess what comes next. Just observe the structure of price relative to the lines. The 3 moving average you see at first are not the final setup. We adjust them, and these adjustments are not random. They're designed to stop you from doing what your instincts want you to do. We take the short-term moving average and adjust it to 20 simple moving average. That line is blue. Then we take the long-term moving average and set it to 200 simple moving average. That line is yellow. That's it. 2 lines. Stupid simple, and yes, a stupid simple always works when the logic is respected. Now, here's the part most people misunderstood. The yellow 200 simple moving average is not an entry signal. It's not telling you where to buy or sell. It's doing something far more important. It's protecting you from yourself. Look at the slope of the yellow line. Is it sloping up or is it sloping down? That single question removes more bad trades than most indicators ever will. If the 200 simple moving average is sloping upward and price is forming above it, you're in an uptrend. No debate. No but what if. That's the condition. If the 200 simple moving average is sloping downward and price is forming below it, you're in a downtrend. Again, no guessing, no opinions, no prediction. So look again at the gold 1-hour chart. The yellow 200 simple moving average is sloping down. Price is below it. That means something very specific. We're not buyers here. Not even a little. We don't care how cheap it looks. We don't care how far it's fallen. We only look for sell trades. That single rule alone saves you from a massive amount of pain. But now comes the part that separates disciplined traders from impulsive ones. We don't sell immediately just because the trend is down. That's how people sell the bottom and then watch price bounce in their face. Instead, we wait. We let price pull back. We let it breathe. On this chart, that means price move back toward the 20 simple moving average. Sometimes it touches it, sometimes it slightly breaks above it. That's fine. The context hasn't changed. Trend is still down. Price is still below 200. Now watch what happens next, because this is where most traders mess it up. They see price near 20 and they panic into a sell. That's not the trade. We wait for a trigger candle. If it doesn't show up, we do nothing. And doing nothing is what most traders are terrible at. No trigger, no trade. That's not discipline. That's survival. Look at the candle. I'm pointing to the chart. Don't name it yet. Just look at its shape. Long shadow, a small body. Color doesn't matter. Red or green makes no difference. What matters is rejection. The candle tells you price tried to go higher and get rejected. Buyers pushed. Sellers shut the door. Here's the rule that keeps the strategy clean. In a downtrend, the trigger candle must close below the 20 simple moving average. On the gold 1 hour chart, you can see the red candle that fits this perfectly. Long shadow, short body. Close below the 20 simple moving average. That's the trigger. The close of that candle becomes the entry for a sell trade. Not before, not during, after it closes. Now let's talk risk, because even a perfect setup won't save you from bad risk management. Never risk more than 1% per trade, ever. This rule isn't about profit, it's about staying in the game long enough for the edge to play out. The stop loss is placed at the most recent swing high for sell trades, somewhere that proves you're wrong, not somewhere that feels emotionally safe. Targets are based on risk. 2R, 3R, your choice. The structure doesn't change. Now briefly flip this logic for a buy trade on the same gold 1 hour chart. When the 200 SMA moving average slopes upward and price is above it, everything flips. You stop selling. You only look for buys, not fighting the trend. Price pull back toward 20 simple moving average. You wait. No rushing. You look for same trigger candle, but inverted. Long shadow, short body. Rejection of lower prices. And just like before, the candle must close above the 20 simple moving average. If it doesn't, you skip it. That patience is what most traders never develop. The close of that candle is your buy entry. A stop loss below the most recent swing low. Targets remain 2R or 3R. Same logic, same simplicity, same protection from stupid mistakes. A stupid simple always works, but only if you actually follow it. On the screen now, you'll see another video suggested next. It breaks down one of the best strategies I've ever revealed on this channel recently. If this changed the way you look at the indicators, hit like and subscribe if you want trading decision based on what the chart confirms, not what hope whispers. Happy trading.